I want to say hello and thank you guys for joining today. What we're going to talk about is something very important. What I would say is business planning, business conversations, and the reason being is that we have a very important group of people to talk to and discuss, where it's also very lucrative for us in the insurance industry. Um, so we talk about business succession planning, as well as how we can help people take care of themselves, take care of their family, because a lot of times people don't realize that they have a problem. That's our job, is to address that and make sure that they're aware that there are certain situations that they need to protect against. So, what we'll talk about today is a few key concepts that you'll typically find in any type of business insurance planning. We're going to talk about buy-sell agreements. We're going to talk about key person coverage, and we'll also talk about executive bonus. And so it's kind of a step down approach per se, where we want to start at the top and then work our way down to I would say to the employees, so to speak, and we'll do so in a tiered approach. So when we dive in and look at, say, the first part here, this is the value proposition. This is the why we do this. When you think about it, you have 33.2 million small businesses in the United States, and 99.9% of them have fewer than 500 employees. So there are a ton of small businesses out there and a ton of opportunity. Small businesses in the US employ 61.7 million people, and 46.4% of it is private workforce. So once again, you have very little overhead. I would say even myself, as a small business owner, we're an army of two, myself and my wife. And as you can see, small businesses pay about 39.4% of the private sector payroll. So a lot going on in this area. That's why it's so important to emphasize or focus on this. And really, businesses don't run themselves, it's the owners. And a great example of that, running a business can offer great rewards. I am eternally grateful for the opportunity to own my own business. But yes, there are significant challenges too. From starting a business, you think solely and focus on the business, and then there's other things that might come into play that you had no idea or didn't even think about, that could impact the bottom line. Maybe not now, but later. So that's why in the times of COVID, it served as a reminder for the vulnerability of small businesses. And that's why we once again have to think and how we can protect and help these people. So we want to start out, like I said, from the top down. We want to focus on business partners. So usually when you think of business, there are sole proprietors, there's LLCs, S corps, C corps. Those are the main ones. Partnerships as well, but a lot of times the partnerships can be sectioned off as LLC too. But when you think of this, not a lot of people think about what happens if the other person passes unexpectedly. So our desired income is always to make sure that upon the passing of someone, there is no blip or change in the trajectory of the company. Our desired outcome in small words would be, we want to kick out unwanted ownership. We want to make sure that the business can still thrive, survive, even at the death of one of the owners. So I'll give you an example here, because when we think about what can happen if you don't have a plan, when you think about the serious concerns that could take place, having owners may lack the financial means necessary to compensate the heirs. I'll give you a prime example. I have a business partner who has a friend in the jewelry business. Now, in the jewelry business, he runs everything. So he goes to wholesale distribution, buys the jewelry, brings it back to his businesses, sells it there. So he does everything. And we sat down with him and said, what's your plan on if you pass away? Well, my business partner will take care of everything. Okay, but does he realize that he will still only own 50% of the business? Well, what do you mean? Well, if you pass away, you have an unlimited marital gift. So all your money does not go to the business partner. The business partner is now not 100% owner. They're still 50% owner, but now doing 100% of the work. Well, the wife, though they may like each other, he may not like doing 100% of the work and giving 50% of the profits to her. So we talk about strategies to help people they call buy sell agreements. You can do a one-way buy sell. So say it's a owner and let's say his wife doesn't want to do it and he's got someone else he wants to basically take over upon his passing, then there's a one-way buy sell agreement. And I'll show you a little graph later on here. Cross purchase between two owners, entity purchases if you have multiple owners, and always, always, always these involve attorneys to set them up, to design them appropriately. Now, us in the insurance industry, we oftentimes will take for face value some business owner says, "Oh, I already have a buy sell set up." Well, I'm going to teach you a little secret. Buy sells are not that complex to read. So, what we can offer is a very simple thing. Can I review your buy sell agreement? How long ago did you have it done? And let's be honest, things change. COVID hit, all businesses changed, no matter what business, large or small. So, did you have your buy sell done before COVID? Are your business partners still the same? Can I review it for you? It's usually like 6 pages. It's nothing crazy, but there should be lingo in there. And if you guys need help with that, I'm here for you. There's no problem with sending me the documentation. I've reviewed it over my 16 plus years of doing this, and it's very easy to uncover opportunity. So, once again, the idea of a buy sell agreement or an opportunity here is to kick out unwanted ownership. Can an insurance policy take the place of if someone passes, they can pay off the wife so she's no longer in the picture? So, one of the other big concerns is what happens to the business if one of the key employees leaves or passes unexpectedly. And this is a huge issue for any business owner if they have that bell cow, that person who pretty much does everything for them. If it's a retail store, is it the person that you can give the keys to while you go on vacation and know they'll lock up the doors and do everything appropriately upon you not being there? So the idea here really is retention of your valuable employees. But once again, the idea is not so much you're trying to find a way to keep them, but more or less trying to find a way that if they unexpectedly pass, you have something in the way of protection for you and your business to stay in the black. You can, let's say you have a high profile VP or a high profile salesperson, and they're your everything. And then there you go out, make the sales, bring them back to sales, bring it to your processors, bring it to your internal people who are crunching the numbers, your CPAs, accountants, the whole 9 yards. They all fall in line on this person and they suddenly pass away. Or maybe they get sick, they have a stroke or a heart attack. There's living benefit stories around that as well. But basically, the idea here is that if they pass away, you need to lure someone else in from a different organization, maybe with a compensation bonus, or to keep the money as part of a valuation to sell the business. That's where you talk about how you can protect yourself against the loss of an unexpected valuable person. Used to be called key man, and we're gender neutral now, so it is key person coverage. And I have a lot of people ask me about this. The owner is technically a key person, right, Phil? Yes, they are a key person. It's their company. However, for the definition of what this is meant to do, it doesn't fall into play there. And a lot of times people will say, well, Phil, these are business expenses. I should be able to write off any type of premiums for protection, right? The answer, once again, is no. These are using after tax dollars to give you an after tax free death benefit to provide the protection to keep the business in task or in force or active. So just understand, when you have people who have LLCs, S corps, partnerships, sole proprietors, those are all pass through entities. It goes on their personal tax returns. So where you could get a potential write-off is with a C corp. Excuse me. And so once again, we're not tax professionals. I am not going to pretend like I am one. So if you have a C corp, say there is a possibility for a tax write-off, you just have to talk to your CPA to discuss that. So typically what can happen if you don't have a plan in place, losing a top employee to another company, losing them to a passing or a living benefit type concern, all of these can happen. I mean, it is, so I say, hey, it's business, all of that can happen. So we talk about key employee retention options. There is a way to do an executive bonus plan, because if I'm a key person and for some reason you're worried about me passing away or even leaving, how are you going to retain me? And that's where we talk about using some type of life insurance opportunity to help, and I'll show you that as well with pretty pictures. What happens to my retirement if my business goes under? That is a huge issue. And when we think about it, the desired outcome is really to make sure that if someone is retiring or they can't do their business anymore, what is the opportunity for them to have some type of takeaway that is advantageous for them? So we think about it. If you don't have a plan, you might end up with more loss than you did gain. You might have to, start over from scratch, especially if, say, you're running a business, some stuff hits the fan, you're closer to your retirement, and then things go down and you can't do it anymore. Now you have to rebuild. And if you're closer to that retirement red zone, we like to say, it can lead to a more detrimental concern for you that can be challenging. So, what we consider for sole business owners is things like the tax free retirement strategy or a LIRP, life insurance retirement plan. You could even call it a SERP. Have you ever heard that phrase before? It stands for Supplemental Executive Retirement Plan. So, having something in play to offer to these clients is very advantageous, especially, like I say, sole proprietor owners. Myself and my wife were partners in an S corp, and we can even set up our own 401k as well. So, thinking about deductions, that's where you can get a deduction. But let's look at how buy-sell agreements are structured. And like I say, we like to use pretty pictures because I'm more of a picture guy versus a word guy. So once again, you see you have owner A, let's say that's Phil, owner B, let's say that's Steve. And so owner A and owner B, Phil and Steve, we own a company together. And all of a sudden, something happens. Well, now owner B, let's say Steve, has to now work with my wife. He loves my wife. They're good friends, but they're not good business partners. So the idea here with this cross purchase is that we both buy an insurance policy on each other. So he is the owner and the beneficiary of my policy, and I am the owner and the beneficiary of his policy. And so, in that respective terms, let's say I pass away. Now, Steve owns the company, but he gets the proceeds from my life insurance policy. That's where what's going to happen is you're going to give the money to my wife. you're basically going to buy the shares off of my wife. She's going to get that death benefit. And now all of a sudden, I'm going to get, or Steve is going to get the entire company. So my wife will be paid out. It'll be fair. It'll be equal. It'll be agreed upon, from the start, because a lot of people will say, oh, we don't need this. We're close family. Well, the hardest part about that is no one knows your wishes after you pass away. And if it's not written down, you're going to have a hard time proving it in court in case someone changes their mind. Maybe my wife doesn't want to be kicked out of the business and there's nothing written down. It was a handshake, nothing to prove. Now all of a sudden, owner Steve is going to have a hard time kicking her out of the business. And so friends are friends, but business is business. You got to write it out. Otherwise, you're going to have some potential concerns that you didn't even think were possible from that standpoint. So that's how, when you have two owners, a cross purchase is the most economical way to do it. When you have several business owners, let's say three or above, you want to visit or think about an entity purchase buy sell agreement where the business now buys a policy on all the owners. Okay. Ugh, that's awful. I'll just get rid of that. So, in this scenario, let's say there's three owners. The business, let's say it's Reshco, buys a policy on Bill, Phil, and Steve, and it's basically the beneficiary is the business. The business owns it, the business is the beneficiary. Upon passing, once again, you take those proceeds and pay off Phil's wife, and now Bill and Steve are 50-50 owners. So it eliminates that concern or issue of someone else coming into the mix, taking out unwanted ownership and leaving it where it's supposed to be at the top with the business owners. And then you have a one-way buy sell. So let's say, for example's sake, we talk about that jewelry store owner. Let's say it's one person, not two, and his objective is to give it to his son. Well, that's the objective. However, upon death, all assets go to your living spouse. It's an unlimited marital gift. So that includes the business. Now the son has to work for the mom. And if the mom doesn't want to give up ownership or rights, well, tough cookies. Now you're working for mom. So the idea is that business owner would get a policy purchased on them by the other person, that key person, so to speak, in this example's sake, the son, to pay off mom or spouse and give the company to whoever is going to now take over. So that's the idea of a one-way buy sell. So even if it's a sole business owner, like, we don't need a buy sell agreement. Okay, Mr. and Mrs. Client, what's your plans on if you pass away unexpectedly? Oh, my wife will take over. Does she know that? There's just some pointed questions because no one thinks about that. How is it going to play out? Or is the business just going to die out if the owner passes away? That would be good to know too. And the biggest thing that you should say is write it down. Most people don't write this stuff down, they don't seek legal counsel. But when you think about it, there's a fight over Tina Turner or Aretha Franklin. I think it's Aretha Franklin. Her estate over a cocktail napkin that was found under a couch. Is that legally binding? I believe they ruled it is. So when you think about it, if you don't have a plan in place, it's a bad plan. It is still a plan. So when you think of other advanced sales concepts, we talk about um, key person. So as we mentioned before, we started at the top with business owners trying to kick out unwanted other business owners. Now it's the employee. So you're taking a business owner at the top, talking with an employee, so one level below. It's that key employee that you can't live without. They're your everything. They're the reason why you do this kind of thing. That's the kind of person you're thinking of here. Once again, premiums are not deductible by employer, highlighted in bold, as I mentioned before. But if someone passes away or has a living benefit need, that's where you can accelerate the death benefit as the business owner because you own the policy on the employee. You can use it, say, you buy permanent insurance, and using permanent insurance, you can use that as part of your business valuation. Say you want to build a wing on Reshco and there's tax free income in there. Instead of taking a bank note, you can use cash value life insurance. That's how Disneyland was built, using proceeds from cash value life insurance. So there are definite perks when it comes to things like this, to protect against having to find a replacement due to a death or a disability or a departure, things like that. Having permanent insurance versus term insurance can be a great story. Most of the time, when you talk about key person as a basic setup or buy sell agreements, those are generally going to be term sales. For the most part, the business owners don't see that as an asset. They usually see it as a bill, and they want to pay the least amount of money possible to cover those concerns. However, when you talk about true retention, let's say, for example's sake, I am a key employee to my business that I work for. Now, in this scenario, there's a different situation. So if someone comes up to me and says, "Hey, Phil, we realize how important you are, so we're going to buy an insurance policy on you." I said, "Well, what's the perk to me? What's the benefit for me? Why, I could care less because this is all. If I die, you get something. However, if I die, what does my wife get?" So that's where usually a key person can be coupled together as one story, or you can buy a term and have the ownership be to the company. And preferably, I would like to do it this way, where the key employee gets their own policy. So the insurance company or the employer does what's called an executive bonus plan, where they will bonus the money to the employee. So say someone comes up to me and says, "Phil, I love you, man. You're doing great. We're going to buy a policy on you in case you pass away. We need Reshco to keep working. And so we're going to get $1 million policy on you." However, what we're also going to do is, because we realize how important you are, we're going to give you an executive plan that we don't have to give to everybody. It is discriminatory. You do not have to give it to all of your employees. So I'm going to bonus you, Phil, $20,000 a year. And what's going to happen is we're going to structure it into a life insurance policy focused not on a high death benefit, but on a very low death benefit to increase the cash potential opportunity for you to get a tax-free retirement plan that no one else is going to get in our organization. And then on top of that, we want you to net out 20,000. So we're going to give you a double bonus where you can actually get the taxes for the first bonus as well as the second bonus in that double bonus strategy. So I will net out 20,000 to put that into a LIRP life insurance retirement plan or an executive bonus plan. Now, some of the benefits of doing that is it does allow the opportunity for the client to stay. I think it's this one. The client to stay in the organization. Say, "Phil, I need you for the next 10 years. I will give you this bonus for the next 10 years if you stay with me to help you build a tax-free retirement plan." So it's what you call a golden handcuffs. Some people might do it only for 5 years, but this is something that also should be written out. It should be a contract, because some people will say, "Oh, well, what if I don't put the money in the insurance policy?" Well, you're not getting the normal value of what you could get from the benefit of a tax-free retirement plan. That's why you see, employees in this plan can save more. They can put more away for retirement. There's not the normal amount of money that you can only put into a 401k and that's it. This is something that goes on top. It's a diversification strategy. This one you can get a tax deduction for as a business owner. So Reshco bonuses me, let's say $26,000. So it's that double bonus. So I get 20,000 net. Well, they gave me a W-2 income of a bonus that I have to pay tax on, but they gave it to me as a wage. So now I, as the business owner, have retained a key employee. I increased their morale because it gave them something to be appreciative about. And now I also get a write-off for another business expense, i.e., another W-2 wage. And so all of these help to give you the opportunity to keep that employee. The asset is not corporately owned, so it's owned by the client. And from that standpoint, they feel empowered. They can use it however they want. Maybe they don't want to use it fully at retirement. Maybe they want to put a down payment on a house. And there's cash value inside of there to help them maybe reduce PMI or eliminate PMI on a down payment. So things like that are very important to these type of plans. You can take out favored loans inside of the life insurance policies. And so when we think about it, when we think about everything that we really talked about today, the whole idea is to seek opportunity to talk to business owners. Now, what I haven't even shared in this presentation, which I think is important to understand, is that's not all. That's the life insurance side of this. So with us here at Valor, we can offer group health, we can offer group life insurance too, group dental. We can offer ACA if they're not a huge company. We can offer Affordable Care Act. We can offer Medicare for those who retire and are 65 now. And we can even offer 401ks. So a great way to even approach a business owner is to simply ask them, have they gotten enough tax deductions for the year? And they say, what do you mean? So have you maximized your opportunity to deduct as much as you can? Or are you still looking for ways to still save money on taxes? Because then we can talk about different ways to approach the business. And that's a good way to get in front of them. 86% of most small business owners have absolutely no retirement plan as well. So once again, speaking from being a first year into this business, I do have my old retirement plan from my 401k from my prior organization, and I put that into an annuity because I can't think about it. I want to let it grow. I don't want it to lose money. Well, on the flip side, I said, oh, I'm going to put more money towards my business and help it grow. Well, same thing. You're so focused on growing the business, you forget about the retirement side. And so that's where us as financial professionals are coming in to explain to them things that they may have already forgotten. And so that's where we can talk about deductions. That's where you talk about unwanted ownership protection, unwanted loss of a key employee, or how to give a bonus plan to your employees that can give you a deduction as well as increase their morale and keep them around. So with that, I would love to say that, this is the end of this presentation regarding business. I will open up for questions. So if you have any questions, feel free to put them in the Q&A.